on the set. Okay, here we go. This is just a quick review of homework number 6, which we didn't get to do in class. A lot of students did pretty good with this. If you had a problem with it, don't worry about it. Let's go over it. Hopefully you'll be able to pick it out easily enough. The question number 1, subsidiary can be excluded from consolidation if A, operating under foreign exchange restrictions, then it can't be consolidated because we don't have control. B, control does not rest with majority owner, same thing, we don't have control. The subsidiary is in legal reorganization, that means we don't have control. The bankruptcy court or a receivership has been appointed, that's what that means, and we don't have control of that, and that means D, all of the above are correct because we don't have control. The whole issue with subsidiary being consolidated is if we have control. So that just drives home that point. Number 2, here we want to know what the retained earnings are on December 31st, 2014 of the consolidated balance sheet. And the key here is, let's see what information we've got. They tell us that on June 1, there was the acquisition. The retained earnings of Purell at that point was $100,000. Sorel had 50. At the end of the year, Purell had retained earnings of 120, and Sorel had 60, assuming the equity method was the manner in which the books and records were kept. And although the prom doesn't tell you that, which is not a great thing, but the assumption is that the professor has only been giving proms with equity methods, so you could have assumed it. In which case, we know the general rule when we did our consolidated balance sheet and income statement. We did that one problem, homework number 5. The general rule was that the retained earnings at the end of the year for the parent, particularly when it's 100% owned, is the retained earnings shown on the consolidated. So it's the same number that Purell had, 120. 120 is answer D. Again, it's only when there's 100% ownership is the consolidated balance sheet retained earnings exactly equal to the parents, and only when the equity method is being used. Should another method being used on the investment account, things change a bit, and we have to do some additional calculation. And when we have less than 100% ownership, the same principle will somewhat follow, so we'll use the principle again, but with just a modification. Number 3, we have this, let's see what we're looking for. It's asking for immediately following the acquisition, equipment will be included on the consolidated balance sheet. So this is not even almost a Chapter 3 question. It's really a throwback to Chapter 2. At the acquisition date is all we're really interested. And let's see what we've got. Equipment was acquired with a fair value of $210, and thus that's the answer. At the acquisition date, equipment will be recorded on the consolidated balance sheet at the fair value $210. Again, simple question really from Chapter 2. Question 4, newly acquired subsidiary had pre-existing goodwill in its books. The parent's company consolidated balance sheet will not show any value for the subsidiary's pre-existing goodwill because, and that's answer A, because it's going to redo goodwill in its calculation of the acquisition date method valuation. We ignore any pre-existing subsidiary goodwill. After all, we're newly acquiring the company, we're newly valuing it, we've got a whole new value we can apply to calculate whatever goodwill really exists in the company at that date. It's an arm's length transaction. So we don't have to go back, and not only don't have to, we can ignore the pre-existing goodwill because we're getting a whole new valuation at that date. All right, moving right along. Bird Corporation, here we go. Bird Corporation, are we in the right spot? I didn't think so. Here we go. In the preparation of consolidated financial statement, which of the following intercompany transactions must be eliminated? All right, so this is a theory question of what gets eliminated. And let's see what we've got. A says revenue, expenses, gains, and losses, but not receivables and payables. And these are intercompany revenues, intercompany expenses, intercompany gains, intercompany losses, intercompany receivables, and intercompany payables. Well, it makes no sense that we should show intercompany receivables and payables on the consolidated balance sheet, because we'd be doubling up the payables and the receivables. If it's between the companies, that doesn't exist to the outside world. We have to eliminate the intercompany payables and receivables. So A is not correct. If the theory of that's not quite clear, take a look at the text and let me know if you need further explanation of that. That's sort of a simple consolidation theory, but it may take some getting used to. If I did it in class. If A owes B and B owes A, and we're showing A and B as partners, you may remember that metaphor. So answer A is not correct. Answer B, all revenues, expenses, gains, and losses, and those are all intercompany revenues, expenses, gains, losses, and intercompany receivables and payables get eliminated, and that looks pretty good. Let's say that B looks like a good answer, and let's just check C. Only sales, revenue, and cost of goods sold. Well, that, I don't know where that comes from. It doesn't even make any sense that we would eliminate we would eliminate intercompany sales, revenue, and cost of goods sold, but why wouldn't we eliminate other expenses and gains and losses, as well as receivables and payables? And answer D also is just not being fully truthful by not eliminating intercompany revenues, intercompany expenses, gains, and losses. So B is the correct answer. Number 6, parent company uses the equity method. Which of the following will be a correct procedure? This really is a throwback to Chapter 1. Just a really basic equity method question. Credit for subsidiary loss to the investment account, which is correct. Credit for dividends received, which is also correct. And then we're done because A is the correct answer. 7, we got Bird Corporation. Bird Corporation has several subsidiaries that are included in its consolidated statements and some that are not consolidated. Here's the year-end trial balance. Ostrich Corporation is the unconsolidated company. The rest are consolidated. So what amount should Bird report as intercompany receivables on its consolidated balance sheet? Well, we know from the last question that all intercompany receivables get eliminated. However, here we've got one particular subsidiary that's not being consolidated for whatever reason, and that's Ostrich, and there is a receivable from Ostrich of $10,000. So B would be the intercompany receivable that should show up because it's not being consolidated. It's not a true intercompany receivable anymore with Ostrich not being consolidated. So B would be the correct answer. That is the receivable that shows up. And finally, number 8, which of the following will increase consolidated retained earnings? The answer here, let's see what it is. We've got choices: the amortization of a $10,000 excess in the fair value of a note payable over its recorded book value. All right, so this question was a little forward-looking, and I'm going to just tell you that this particular type of question with the note, answer is A, and the reason for A being the answer has not been explained in class, so this is not going to be part of your quiz, and therefore we don't have to go through the rationalization. That'll be part of a classroom discussion coming up this week. By the way, in preparation for the quiz, the best way to study would be to go over homework number 5, I believe, is the end chapter 3 itself, but particularly homework number 5 and the concepts of what we do with homework number 5, because if you can visualize that, I think that's going to be your best way to answer the questions, which will be a little bit challenging, I must say, on this quiz coming up. But it's challenging in order to stretch your cerebral hemispheres in the best interest of you becoming great accountants. So I'll see you this week. Thank you very much.